In the fall of 2011, the newly appointed chief executive of a century-old technology giant made a startling discovery about his own employer. He found that the corporation had spent over $1 billion acquiring obscure, unprofitable businesses that had absolutely nothing to do with its core industry. This was not a strategy of aggressive diversification or a series of misguided investments. It was the final, desperate phase of a carefully engineered financial illusion designed to conceal a devastating secret from the world. For decades, Olympus Corporation stood as a paragon of Japanese precision manufacturing, dominating the global market for medical endoscopes and consumer cameras. Yet beneath this pristine exterior, the company was actively hiding $1.7 billion in investment losses. The deception stretched back to the 1990s, sustained by a complex web of financial maneuvers and a deeply ingrained corporate culture that prioritized reputation above all else. Understanding this facade requires looking past the immediate fraud to the economic conditions that first set the trap. The roots of the crisis began during the Japanese economic bubble of the late 1980s. As the value of the yen surged, traditional export revenues for manufacturers began to shrink, placing immense pressure on corporate balance sheets. To maintain the illusion of perpetual growth, many conservative companies turned to high-risk financial speculation, a practice known as zaiteku. Executives at Olympus deployed corporate cash into volatile markets, hoping complex financial engineering would bridge the gap left by slowing export profits. When the asset price bubble inevitably burst in the early 1990s, those speculative investments turned into massive liabilities. In many global markets, standard procedure would dictate taking a painful write-down, accepting the loss, and facing the wrath of shareholders. However, the intersection of culture and corporate expectations created a different set of incentives. Admitting to such catastrophic financial mismanagement meant a profound loss of face for the executives involved, a prospect viewed as culturally unacceptable within the rigid hierarchy of the boardroom. Rather than confessing to the financial damage, leadership chose to hide it through an accounting maneuver known as a Tobashi scheme. The term translates loosely to flying away, which perfectly describes the objective of the mechanism. The company systematically transferred its unrealized losses off its own balance sheet and onto the books of newly created external entities by shifting the toxic assets out of public view. The core business could continue reporting steady profits to an unsuspecting market. Executing this strategy required the creation of numerous shell companies, often located in jurisdictions with strict corporate secrecy laws. Olympus would inject capital into these shadow entities through ostensibly legitimate investments or loans. The shell companies would then use that capital to purchase the toxic assets from the parent company at their original inflated book value. On paper, the parent corporation appeared financially healthy, while the hidden entities quietly absorbed the catastrophic reality of the market crash. Maintaining this elaborate architecture demanded continuous cash flow and increasing complexity over the years. The shadow network needed funds to pay administrative fees, service debts, and maintain the illusion of legitimate business operations. To funnel money to these entities without raising suspicion, executives disguised the transfers as exorbitant advisory fees and wildly inflated acquisition costs for unrelated businesses. The structural integrity of the entire corporation now depended on a relentless cycle of falsified transactions. This long-term deception was only possible because of a profound failure in corporate governance. The board of directors functioned as an echo chamber, dominated by internal executives who valued loyalty and consensus over independent oversight. External auditors, who were supposed to serve as the final line of defense for shareholders, repeatedly signed off on the opaque financial statements. The internal control systems were entirely circumvented by the very people entrusted to enforce them, creating a dangerous vacuum of accountability. The carefully maintained silence finally broke with the unexpected promotion of Michael Woodford. As a longtime European executive for the company, he was elevated to the role of president and eventually chief executive officer. His appointment was initially intended to signal a modernization of the company to international investors. However, as an outsider to the traditional headquarters hierarchy, he did not share the unspoken obligation to protect the legacy of his predecessors. Shortly after assuming control, the new chief executive began reviewing recent corporate acquisitions and immediately noticed glaring financial anomalies. The company had paid nearly $700 million in advisory fees to obscure Cayman Islands firms for the purchase of a British medical equipment manufacturer. This fee represented roughly one-third of the total acquisition price, a figure completely unprecedented in standard corporate finance. The sheer audacity of the numbers demanded a thorough internal investigation. The scrutiny deepened when he examined 3 other domestic acquisitions that had cost the company nearly $1 billion. These targets included a manufacturer of microwave-safe plastic containers, a face cream company, and a waste disposal firm. None of these businesses possessed technology or market share that justified their exorbitant price tags, nor did they align with a precision optics strategy. The acquisitions were clearly a conduit, a method for moving massive amounts of capital out of the corporate treasury. Armed with forensic accounting reports, the chief executive confronted the board of directors, demanding an explanation for the missing capital. This direct challenge violated the established norms of the boardroom, where aggressive questioning of senior colleagues was considered deeply disrespectful. The clash highlighted a fundamental disconnect between Western expectations of fiduciary duty and a localized corporate culture that demanded absolute deference to authority. The board viewed the inquiries not as a necessary audit, but as an intolerable act of insubordination. In a swift and unanimous decision, the board of directors abruptly terminated his employment, citing a failure to understand the company management style and cultural differences. He was ordered to vacate his office immediately and surrender his corporate devices. The leadership assumed that removing the dissenting voice would restore order and preserve the decades-long secret. They fundamentally miscalculated the determination of their former executive and the changing dynamics of global information flow. Fearing for his safety and recognizing the scale of the deception, the ousted leader immediately left the country and went straight to international financial journalists. He handed over the internal forensic reports, transforming a quiet boardroom dispute into a highly public 2011 financial scandal. The revelation that a pillar of Japanese industry had been operating a massive shadow ledger sent shockwaves through global markets. The protective bubble of institutional secrecy had finally burst. The immediate consequences for the corporation were devastating as the financial reality aligned with public perception. Within weeks, the company lost more than 70% of its market capitalization, erasing billions of dollars in shareholder value. Major institutional investors panicked, demanding immediate regulatory intervention and a complete overhaul of the leadership team. The very reputation the executives had sacrificed so much to protect was now irreparably shattered on the global stage. As investigators unraveled the complex web of shell companies, a surprising truth emerged about the underlying motivations. This was not a case of executives embezzling funds to enrich themselves personally. Instead, it was an institutional fraud driven by a collective desire to protect the corporate entity and avoid the humiliation of failure. The architecture of the deception revealed how powerful psychological incentives can override basic ethical boundaries when a group prioritizes self-preservation over reality. The fallout extended far beyond a single technology company, casting a harsh light on the systemic vulnerabilities within broader market structures. International investors began to question the reliability of financial reporting across the entire region, fearing that other legacy corporations might be hiding similar Tobashi schemes. The scandal exposed the inherent dangers of a corporate ecosystem where cross-shareholdings and passive boards of directors insulate management from genuine accountability. In response to the crisis, regulators were forced to implement significant reforms to rebuild trust in the market. New guidelines were introduced requiring publicly traded companies to appoint independent, outside directors to their boards. The mandate aimed to dismantle the traditional echo chambers and ensure that dissenting voices could challenge executive decisions without fear of immediate retaliation. The goal was to shift the balance of power back toward shareholders and away from entrenched management teams. The anatomy of this cover-up provides a profound study in behavioral economics and the escalation of commitment. What began in the 1990s as a temporary measure to smooth over a rough financial quarter gradually morphed into a permanent structural necessity. Once the initial deception was committed, every subsequent leadership team was forced to inherit and expand the lie. The psychological burden of confessing grew heavier with each passing year. making the eventual collapse increasingly catastrophic. The long-term societal impact of such institutional failure is the gradual erosion of public trust in legacy organizations. When a respected brand with a century of history is revealed to be a financial mirage, it challenges the fundamental assumption that established systems are inherently stable. Employees, investors, and consumers are left to navigate a landscape where the official narrative can no longer be accepted at face value. The damage to the social contract often takes generations to repair. Ultimately, the survival of any complex organization depends on its capacity to process uncomfortable truths. When a system is designed to punish transparency and reward the appearance of success, it will inevitably construct a reality based on fiction. The true vulnerability lies not in the initial financial loss, but in the mechanisms built to hide it. A culture that prioritizes saving face will eventually run out of places to hide, because understanding why it happened is the best way to recognize it happening again. If you enjoy breaking down the incentives, decisions, and systems behind corporate scandals, not just the headlines, subscribe for new investigations every week. Because understanding why it happened is the best way to recognize it happening again.